All right, good morning everyone. Welcome to our webinar on business revival, how to avoid being a zombie business. Before we kick things off, just like to quickly draw your attention to the housekeeping slide that's currently showing on your screen, or will be shortly. There we go. To start, obviously, everyone's automatically muted, but we will be accepting questions throughout the session. So you can submit these questions via the Ask a Question tab there on the screen. We'll try to get to as many questions as possible during the webinar, but obviously if we can't get to everyone, please feel free to get in touch with us after the webinar concludes, and we'd be happy to respond to you directly. All the slides that we're using today are available for download in the handouts tab. If you're experiencing any technical difficulties, please click on the support button, which is the one at the bottom of the screen. Do not put technical difficulties in the chat. I can assure you that Andrew and I are not able to help you with those sorts of difficulties. And finally, the session's being recorded, and all registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions, and the speaker contact details for both of us. So we might kick off by introducing ourselves. So I'm first. My name's Will Sinclair. I'm a partner in BDO's business services team. I should start by assuring you that that actually is a photo of me. I've obviously gone for a post-zombie apocalypse look in keeping with the theme of the webinar today. So as I said, I'm a partner in the business services team. Typically, we spend most of our time assisting our clients who come from a broad range of industries, but typically sort of family business, privately owned businesses and SMEs. And typically what we do is we help them with a whole range of tax and general advisory issues. But in recent months, probably comes as no surprise to anyone that the vast majority of what we've done has been trying to assist our clients in navigating what's been a pretty extraordinary period of time. That's meant we've had a lot more of a focus on things like cash flow modelling, conversations about business plans and structures, and of course particularly conversations around accessing government stimulus measures and things. Obviously, you've spent a lot of time talking about our beloved JobKeeper. So delighted to be here today to talk about some really interesting issues. And I'm joined today by my colleague, Andrew Solway, who's also a partner at BDO and works in the business restructuring division. And I'll just let Andrew introduce himself.
Thank you, Will. Good morning, everybody. Looks like a good session today, Will. I think we've got more than 200 people registered and already questions coming through to keep us occupied. Yes, I'm a partner in the business restructuring team. Half of my practice is taking insolvency appointments, so voluntary administrations, receiverships and liquidations. And the other half of my practice really is helping stakeholders deal with underperforming businesses and helping them engage and think about options and scenarios and alternatives and help them avoid insolvency, which certainly from my perspective is the more rewarding work, and certainly from our clients' perspective is what they're hoping to achieve as well. Thanks, Will.
All right, thanks very much for that, Andrew. And I think it's probably fair to say, based on the type of registrations that we are seeing and a lot of the questions and things, I think there's certainly a lot of interest there in hearing from Andrew, and probably more interest in hearing from him than me. So I'm very interested to hear from Andrew as well. So I might try and get through my section of this reasonably quickly. As I said, any questions come up, please feel free to ask them. So I just wanted to start by revisiting some of the government stimulus and support measures and sort of show how, as well-intentioned as a lot of these things were, how they're possibly contributing to some of the difficulties that we might see down the track. And the reason for this is that the current economic environment is probably a little bit unique in that it's nearly sort of a self-imposed, government-imposed downturn. That there's been a reduction in demand and in production, which has been sort of driven by these government-imposed measures to respond to the COVID, pandemic. And so having done that, the government has also then sought to assist businesses by sort of rolling out a whole suite of support measures that were designed to effectively prevent a lot of businesses from deferring on loans, having to cut their staff, and possibly even trading while insolvent or effectively going broke, by effectively sort of assisting them to go into hibernation for what was sort of assumed to be the initial period of this COVID pandemic. And sort of the basis of that position taken by the government, which I think was the right move at the time, was that this crisis would have an ending point, and in many cases, the arbitrary finishing point that was sort of built into a lot of the measures was the date of the 27th of September, which was broadly 6 months after the crisis began. And back in March, when a lot of these things were rolled out, that seemed like a pretty good runway for businesses to manage their way through this period. That was 6 months ago. Obviously, the 27th of September seemed to be a long way off at that stage. And now we sit here today on the 2nd of September, and it's just over 3 weeks away. And so because we've reached a point in this crisis where a lot of these measures, a lot of the stimulus and support measures are about to come to an end or to be wound back, it's just really vitally important for business managers, for wherever they sit in a business, to be really aware of how they're going to manage their business through the next phase of this crisis. And so that's probably where the reasonably evocative sort of title for this webinar comes from, is this concept of businesses which are otherwise dead, but which are sort of kept alive or are still walking around because of their reliance on all of these various measures, which have sort of been put into place to help business hibernate and to effectively prop them up for a period of time. So just wanted to sort of talk about the various measures that have been in place and how the end of those might have an effect on businesses. Obviously, the first one is JobKeeper. I think JobKeeper at this stage has probably been done to death. Obviously, $1,500 per fortnight for eligible employers and employees. This has been there's been an absolutely enormous uptake of this program. So I think I was reading some figures yesterday which indicated there's about 750,000 employers who registered for JobKeeper and about 4.7 million employees who are receiving the JobKeeper payment. That's about 35% of the workforce. And even though it's not listed here, in addition to that, there's about 1.6 million people who were receiving the job seeker supplement, which is effectively the increase in the unemployment benefit. And again, I'm going to talk a little bit more about JobKeeper 2.0 in a minute, but again, both of those things are due to come to an end effectively on the 27th of September. Obviously, JobKeeper has been extended, and I'll talk a bit about that, but I would have thought that for the vast majority of businesses, it's going to be much harder for them to get into the program moving forward. One of the main points I wanted to make about JobKeeper is that it's certainly not too late to get into the program. The test is based on projected GST turnover for a month right up until September, so that the window is not closed in terms of JobKeeper 1.0, but it is closing, and we've certainly been helping clients to access JobKeeper all the way through. The last client who I had registered was in August, so just last month, so they only qualified for the last 5 fortnights of the program, but certainly still got into it. The second thing I wanted to mention was the HEO assistance and support, which has been a really underrated measure that sort of was provided to businesses to help them through this period. And effectively what the HEO did was that they made it much easier for businesses to defer the payment of certain tax debts and to defer it without any general interest charges on late payment or late payment penalties. And that's been really generous, and I've certainly seen a lot of clients who've taken that up. But again, that is not an elimination of debt, that is simply a deferral of debt. So we've seen a lot of clients who have quite rightly taken that up, a lot of businesses have quite rightly taken that up. And but all it's done is it's sort of kicked that debt down the road. So again, just something to keep in mind as we come into the next phase of this process. The small business government-backed loans up to 50%, up to loans of up to $250,000. Andrew might have some thoughts about this, but my experience is that we haven't seen a lot of businesses taking this up. I don't know what the numbers are, but I've certainly had some clients who inquired about it, but the applications still needed to go via the banks, via credit at the banks, and we certainly haven't seen a great uptake in those loans amongst our client base. The commercial rent relief is a really interesting element, and again, sorry, Andrew.
Will, did you want me to I was just going to make a comment on the small business loans. Yeah, I mean, I think generally speaking, businesses have been able to access unused facilities that they have with their banks. Very few have taken up the $250,000 loans from the banks. And to the extent that they are, they've been expensive. They're not consistent with current rates. Yeah, so that's all I was going to say.
Yeah, no, I appreciate that. That's certainly in keeping with our experience as well, is that that's not an element of the support and relief measures that's been very widely accessed or very widely used. The commercial rent relief is a really interesting one. This is where businesses which were heavily impacted by COVID, which effectively meant that they were able to access JobKeeper, were also able to access a deferral or a reduction in their rent, which was negotiated with their landlord. It's been very interesting to see how different people have approached this, but again, it's that period is going to come to an end. It's a little bit difficult to pin down exactly when, given that the legislation around this sort of anticipates a reduction for the period of the COVID-19 pandemic and a reasonable period of recovery afterwards. And I think that broadly that was meant to, sort of was envisaged to be and was read by most people to mean until the end of JobKeeper, to the end of September. Obviously, JobKeeper has been extended. There's no real indication that this COVID pandemic is coming to an end, certainly not for our friends down in Victoria. And so that's a really interesting one to see whether people will continue to access that, continue to extend access to commercial rent relief, and how much appetite there will be to do that. The small business cash flow boost, this was $100,000 cash payment to eligible businesses pegged to their POIG withholding. Again, only mention it because that is also due to come to an end. It was paid in two phases, the first one being prior to 30 June, and then the second one being the 4 months or the 2 quarters ending on the 30th of September 2020. So again, a lot of businesses have accessed these funds and they've been fantastic to help them through, but it's coming to an end. The increase in the instant asset write-off and accelerated depreciation, I won't mention, not aware of any clients who are accessing that. That goes through until the 31st of December, so we may see some more there. Obviously, various state-based relief measures, again, which I won't go into. Obviously, one of the most interesting things has been the changes to the Corporations Act around the company solvency safety net and relief for directors from insolvency provisions. But again, I'll get Andrew to talk about that as well. So JobKeeper 2.0, I just wanted to very quickly sort of talk through this. Murphy's Law, as luck would have it, the legislation for JobKeeper 2.0 was passed overnight. So obviously just trying to sort of catch up on it this morning. It has been broadly as anticipated and as per Treasury. So the reason why I wanted to mention this is that on the face of it, on the basis of what we know to date, it is going to be much harder for businesses to access JobKeeper 2.0 than it was to access JobKeeper 1.0. And the reason why I say on the face of it, that's the case is because the way the JobKeeper legislation works is that it's enabling legislation. So effectively it enables the Treasurer to make rules around the application of JobKeeper and the rules for how it will be accessed and how you determine what is an eligible business and who is an eligible employee. And so while we have the legislation, we don't as yet have the rules. It's interesting here that the cost of the first phase of JobKeeper was about $70 billion. And then I read this morning that the budget for the next phase of JobKeeper is about $32 billion. And so, given the reduction in the rates, which is going to happen from the 28th of September, that budgeting seem to indicate that a majority of businesses are anticipated to sort of stay in the program. But based on what we know, and as you can see per the slide here, the rules around it are getting much more difficult. So the rules for accessing JobKeeper from the 28th of September are going to be much stricter than they were to access the first phase of JobKeeper. And the reason for that on the face of it is two. First of all is that, businesses must meet the decline in turnover threshold for the September 2020 quarter to stay in the program from the end of September. And that's very different to the first phase where you had effectively sort of a wide range of periods for which you could apply, being one of the 2 quarters in the first phase or any one of the months in the first phase. The second reason is that the second phase of JobKeeper, the application is going to be based on actual GST turnover, whereas the first phase was based on projected GST turnover. So again, much easier to get into the program when it's based on projections than on actual turnover. And we certainly saw plenty of businesses who were quite rightly able to access JobKeeper on a projected basis, but whose business, as it turns out, didn't suffer sort of the sort of downturn that they anticipated. And the third reason why it's going to get much harder to access the second phase of JobKeeper is that there were a wide range of alternative tests available in JobKeeper 1.0. And at this stage, we haven't seen any indication as to whether or not there will be the same alternative tests for JobKeeper 2.0. So that's probably all that I will say about that at this stage, only that my inclination is looking at my client base and the businesses that I've helped access JobKeeper is that it is going to be much harder to access JobKeeper 2.0 than JobKeeper 1.0. But until we see the final rules, we won't know that for sure. And it may be that it will be easier than we think, that the detail is yet to come, but that is yet to be seen. But the last thing I'll say is that the lesson we learned from the first phase of JobKeeper was that you need to look at each business individually to determine how the rules apply to that business and whether or not they can access the program. We had a large number of businesses which, on the face of it, were going to find it very difficult to access the program, but when we looked at the rules closely, they were able to get in, which was fantastic. So just to move on, so this is when the COVID pandemic first started, this slide was effectively our advice to our clients. We called this the react phase. And the reason why I'm showing this again is because my feeling is that we're nearly entering a second react phase. So where even though we're sort of 6 months into the pandemic, we're entering a new phase where a lot of the support measures are falling away. And so a lot of businesses are going to have to react to the new world again. So when I'm talking to clients, I'm really encouraging them to revisit this plan and to go through the steps again and to make sure that they're being really disciplined in terms of all of these steps. So broadly, step one is building a new world cash flow forecast. And I can't tell you how important this is. We've been talking to clients across the board about developing cash flows and clients who didn't previously have cash flow forecasts, we've been getting them to do. We'll talk about it again a little bit later, but we are running later this month, we're running another one of the half-day workshops for business owners where we'll be effectively giving them a cash flow tool for their organization. It's a seminar where you'll be able to go in and build a cash flow tool and in conjunction with some BDO experts and things. So we'll be talking about that again later, but I think that's really crucial because then that allows you in step two to sort of really look at how your cash is sort of being, what your cash burn rate is going to be so that you can identify whether you're going to be running into any cash flow difficulties. And I think that in this next phase, it's just going to be absolutely crucial to be able to anticipate when the difficulties are coming and to be nimble enough to sort of work through them and to make the right steps to get through it. And that means sort of identifying overheads to defer or adjust, the equipment leases, rent, employee costs, capital outflows, all those things. Also encouraging clients to engage with all their key stakeholders, potentially to talk about standstill arrangements, really key to be on the front foot in terms of managing your cash and understanding, what your obligations are to your creditors, to the ATO, looking to negotiate and, and talk to your advisors and things to help get through that period. One of the things I didn't mention when I was talking about 2.0, JobKeeper 2.0, is that there has been sort of an extension of the changes to the Fair Work Act, which are going to make it easier for businesses which aren't going to continue in JobKeeper to continue to be more flexible with the workforce, and I think that will be really crucial. And then, sort of step 4 and 5 are reasonably sort of linked, making sure that you look at what other equity is available, what other cash sources are available, talking to your existing financiers, bringing them into the tent and having conversations with them, thinking about other opportunities to bring equity and capital into the business, which I think is going to be sort of tough enough. Are there logical buyers who you can bring in? Do the existing shareholders have capacity to inject capital? Are there any assets that you don't need or are non-core that you can realise? Obviously, considering government support available, this is the really crucial one. That a lot of that is going to fall away, and I think that businesses really need to be ready for that. And then we get to this point where we're developing a 90-day business rescue plan, which is really the plan to implement the cash flow measures that you've identified throughout this process, and making sure that you're engaging with all the relevant stakeholders to do so. And I think 90 days, I just think, is absolutely crucial. It's such a fast changing environment that anything more than that, you run into the risk of it no longer being relevant. And then obviously just continuing to monitor and update that process throughout. So I think that these, probably the 5 things that I would talk about with clients as being really crucial through this new post-keeper environment is, first of all, that the really crucial maintaining a flexible cash flow plan, being nimble enough to identify when the cash shortages or cash pressure is going to come, and having a plan to respond. Have a good understanding of your balance sheets. Again, this is really crucial. We work with a lot of clients who will do a budget for 12 months or for whatever period in advance, and have a really good feel for what their profit and loss will look like. Particularly, they know what their revenue looks like. They know what their main costs are, but not enough clients consider what their balance sheet is going to look like, and particularly through this phase where a lot of the liabilities may have been pushed out further down the track. ATO liabilities, you may have negotiated deferral of commercial rent. You may have sort of leave entitlements building up with your employees. So really important to not only have an understanding of what your profit and loss looks like, but also, what does our balance sheet look like? If we're going to be in a position where things are going to start to get tight, how does that affect our balance sheet, and making sure that we're on top of that. Obviously, carefully managing costs and inventory is going to be really crucial. Number 4, keeping a close eye on trade debtors and collections. I'm really push clients to do this. I think that there will be a slowdown in the collection of debtors, will be one of the first impacts to happen, I think, in the post-JobKeeper environment. And there is no silver bullet in terms of debtors and collecting cash. It really is the clients who are good at it are the ones who have a process in place and who are really diligent in following it and chasing people up. With debtors, you just have to be a massive pain in the ass. It's just, there's no other way to say it. And then step 5, obviously some self-interest here, but I really do think that seeking expert advice is really crucial. Obviously, we are available to help our clients and anyone who wants to contact us to get through the sorts of steps we talk about and to have the conversations we've talked about in the react phase. But I'll probably take this opportunity now to throw over to Andrew, because I think that he'll be able to explain why people in his position, it's really important to be able to talk to experts in that area as well, just to understand your obligations, particularly if you're a director of a company, and your obligations there. So on that note, I might throw over to Andrew, and I'll skip that slide. Sorry about that.
That's okay. Will, I was just going to say, Will, a question has come through about JobKeeper. Do you want me to read that out for you now or deal with it at the end?
Yeah, we might. we might do it at the end.
Okay.
Yeah, I can see the question there, and we might answer that one at the end. Yeah.
Yeah, very good. Okay. All right,
Thanks
then
for that.
that's okay. Over to the next slide then, from an industry perspective. So I've just put up there, I guess, some industries that we think are doing well, some that have been impacted but will bounce back, and some that will have longer term issues. Rather than read through all of those, I'm just going to share perhaps a bit of what I'm seeing in my practice at the moment. From an insolvency perspective, in the last couple of months, we've taken appointments in the pubs, club space, a charity business, a ticketing events business, and a wholesaling business that sells to businesses in the retail sector. On the other part of our practice, which is the advisory side and working with stakeholders and businesses that are underperforming, we're working at the moment with landlords. We're working at the moment on an air freight business, a real estate business, a retailer that sells into the building supplies, a food manufacturer that's having some troubles, and an automotive parts wholesaler retailer as well. And all of those engagements, some are for directors, some are for shareholders, some are for banks. So there's a bit of a mix there, but I think a lot of those are just helpful and give some credibility or some context to the industries that I've mentioned above. I'll just turn over the page now. Over the page, Maddie. Thanks, Maddie. So we obviously have started to see some failures, and there's been some high-profile voluntary administrations in the last couple of months of selection there that you've seen. Interestingly, one of the recent insolvency appointments that I took, the director said to me, look, there's no such thing as bad news at the moment. We can use, and he was quite thoughtful and insightful. He said we can use the voluntary administration process to restructure the business, and he's sort of thinking about exiting, and we're working with him to do it, obviously. Exiting some of the underperforming business units that he's got, some of the underperforming locations, in other words, retail sites, and getting rid of some of his loss-making supplier arrangements. And what the focus is on, whether it's on the ones that are on your screen or on the businesses that we're working on, is that at the core of a lot of these businesses, there's really valuable IP, there's a loyal customer base, and there's some really experienced people in management, and all of that is value, and that value can be preserved and is being preserved at the moment, albeit through insolvency processes, which probably hasn't happened in the past. Over the page, please. Thanks, Maddie. I just thought I might talk first of all about the current position around insolvent trading. So I'm sure many of you will know that directors are personally liable if a company continues to trade whilst insolvent, and to make sure that companies and their directors have the confidence to, I guess, to continue to trade, to continue to keep the doors open in some way through the coronavirus pandemic. Directors have effectively been, temporarily relieved of this duty to prevent insolvent trading. Now, it's a temporary measure only, and as it says there on the screen, it was for 6 months ending on the 24th of September. And the point that I wanted to make about that is that I actually had a question before the meeting today, is whether or not that moratorium is going to be extended. As it stands, there's been no formal announcements about the extension of this direct moratorium. Conceptually, I have a problem with it, because you can't have a state government on the one side effectively mandating a lockdown of businesses, but on the other side we've got a national legislation in the Corporations Act holding directors to account from the 24th of September around insolvent trading. So I don't know what's going to happen there and if that's going to be extended. I do know that there's the professional group of liquidators that I'm a member of, called ARETA, has actually made a submission to the government saying that the moratorium should not be extended, and the basis being that the current lockdown is being used and the moratorium is being used to avoid and delay paying creditors, which in turn has, flow-on effects onto other businesses. And we're creating, as is the topic today, we're creating this this notion of a zombie business, businesses that aren't trading, can't get cash, are avoiding paying cash. So I think that's a bit of a stay tuned is my feeling. I just can't believe that it wouldn't be extended. I thought I would just quickly talk about what actually is the definition of solvency and what is the definition of insolvent trading. So the Corporations Act defines solvency as being able to pay your debts as and when they become due and payable, and that's under Section 95A of the Corporations Act. And to be honest, that's it. That's the definition. Doesn't really help. And so what's happened over a number of years is that this particular statutory definition has been taken to court, and the courts have provided considerable amount of guidance and tests around how directors can assess solvency. Perhaps the most famous case of all was a case called Waterwheel, which was back in the 1990s, and that involved John Elliott, who's the Victorian, the AFL identity. But what's been developed by the courts over time is this practical test, which is twofold. The first one is a cash flow test, which really looks at, I guess, a daily, weekly cash flow over what we've interpreted as being a 3-month or 13-week period. And we think that, over that 13-week period, that's a business's normal working capital cycle, and a cycle upon which, all of its debtors and all of its creditors will become due and payable or collectible. And so it's appropriate to look at one typical working capital cycle of a business. And that's really built up, this cash flow test is really built up by looking at your projected receipts on a line-by-line basis from your customers and tax office, and as is the case now, government initiatives. And then looking at your line-by-line payments, bank, deferred rentals, deferred ATO payments, as well as your normal supplier payments as well. You can also do the balance sheet test, which is really looking at, obviously your assets minus your liabilities to get a net asset or net liability position. That is, I would say, an additional test, a way of assisting an assessment of solvency, but the courts have shown over the years that greater weight should be given to the cash flow test. Over the page, thanks, Maddie. Here's some guidance on how I think insolvency or solvency can be assessed. It's very important to start with some really good, accurate opening financial information on the current position. And this goes to what Will was talking about a moment ago, about having a really good understanding of the balance sheet, because you need to understand the extent to which you have a build-up of legacy creditors or a build-up of legacy debtors that aren't being collected. So you need a really good foundation for preparing your forecast model. And then it has to be on a 3-way basis. And by a 3-way forecast model, I'm talking about a profit and loss, a balance sheet, and a cash flow, and all those things link. And it'll be, typically on a monthly basis, looking out over a 12-month or 18-month horizon. Of course, I don't need to tell any of you on this call that, forecasting at the moment is incredibly difficult. I think, you could say probably that this time next year or June, July, or whatever it might be, there's a degree of confidence perhaps as to what that might look like. But forecasting what's going to happen in September and October is, quite frankly, very difficult, with things constantly changing all the time. And so, one of the most important things in all of this, when you're assessing insolvency, is that it's not a job that you do once a year when you have to lodge your annual statement with ASIC and sign the solvency declaration. Assessing solvency, particularly in the current environment, and particularly if you're deferring debts and having trouble collecting from your customers, it's something that I would recommend should be an agenda item every month on the directors' meetings. And I would say that it's something that, as a bare minimum, the financial controller or CFO should be looking at least on a weekly basis and having a discussion with the general manager or CEO about these issues. And again, by exception, outside of the monthly turnover, by exception, raising those issues with the chairman and or directors. As sort of Will was alluding to, he talked about that plan at the start, the step plan. It's very important once you've prepared this modelling is to then consult with stakeholders, because no doubt in your model you've made assumptions, particularly around the timing of payment to people. So consulting with your bank, the tax office, key suppliers and key customers, and consulting with shareholders if need be around dividend payments as well. It's important that all of those key stakeholders are bought in to whatever the forecast model says. And if it needs to be changed, then update the forecast, take the feedback from key stakeholders and continue to update the model as required. And continue to update the model for actuals as they occur every month. And the last point that I'll make there is, the importance of running scenarios and running a worst case scenario. I think that the point of preparing a worst case scenario is, you might have an assumption that says, look, if we continue to run at 50% of our normal sales, that is a worst case scenario. And by running that scenario in a three-way forecast model, you'll come to understand how long your existing cash reserves will last. You'll come to understand whether or not you've got a problem with your bank. Is it this month? Is it next month? Is it in 5 months' time? And you'll also come to understand the impacts of those things on financial covenants with your bank. Over to the next slide, thank you. Thanks, Maddie. I'm just going to take a glass of water. There was a question before the meeting today that came through in the registrations about Safe Harbour. So I've added in some slides today about Safe Harbour. I also presented last week to the Accommodation Association, and again, Safe Harbour was a topic that took up a fair bit of question time at the end and was also raised in advance as well. There's not a lot of awareness of Safe Harbour beyond perhaps the people that legislated it back in September 2017, and it was some legislation that was introduced back during the Turnbull government, his innovation agenda to encourage and to foster a rescue culture of businesses in Australia, and in effect to stop directors placing companies into administration or liquidation prematurely. And essentially what Safe Harbour is it's a license to trade whilst insolvent. It's not dissimilar to the current COVID-19 insolvency moratorium that's in place, although there are some additional requirements of Safe Harbour to qualify, which I'll come to in a minute. But importantly, what Safe Harbour doesn't do is that it does not cover other breaches of directors' duties. So by that, I'm referring in particular to the section 180 to 184s around acting diligently and in good faith and all those sorts of things. It's only a moratorium for insolvent trading. Over the page, please, Maddie. So I'll just quickly scan through these because people aren't always interested in the technical aspects, but it was a new section in the Corporations Act called 588GA, which is that a director is not personally liable for insolvent trading if upon suspicion of insolvency, the director starts developing a course of action that will lead to a better outcome for the company, and that any debts incurred directly or indirectly for that better outcome, so it absolves directors of that. You do need to have appointed an appropriately qualified advisor. Typically that's somebody like myself, a registered liquidator or somebody who has turnaround and insolvency experience. And this concept of leading to a better outcome in the course of action, there isn't really much guidance around a view or a probability on how much that better outcome needs to be. It does not require, for example, a better than 50% chance of achieving the better outcome, but the explanatory memorandum does say that it mustn't be fanciful or remote. I'll just add that there's no statutory obligation to notify anybody that you're in Safe Harbour, although obviously if you're a public company listed on the Australian Stock Exchange, there are continuous disclosure obligations, and the ASX has issued a guidance note on listed companies in Safe Harbour. Over the page, please. So for Safe Harbour to be available, directors must ensure that employee entitlements are up to date. That's critical and written into the legislation. And this, of course, includes superannuation. So if you have unpaid superannuation over a number of months, you don't qualify. The second limb to being eligibility for Safe Harbour is that you must have all of your tax returns lodged, and they must have been lodged on time throughout the Safe Harbour. Importantly, though, payment is not necessarily required. It's just that the lodgement must have been made. And what we see is that, Safe Harbour is really a really good way of, giving directors the confidence that they need to keep businesses going. Over the page again, please, Maddie. This is, I guess, a talking sheet that we use when we sit down with businesses to talk about what a Safe Harbour plan looks like. Now, Will spoke earlier about having a 90-day business plan and the step plans, including cash flow forecasting. And importantly, those things will form part of a Safe Harbour plan. And it would be an expectation that if a business is underperforming, that they're preparing those things, and that information, those forecasting and step plans may lead businesses to come to the conclusion that Safe Harbour is worth investigating. And so the major steps there that we have is that you have this suspicion of insolvency or a risk of insolvency, and that would arise from the forecasting and analysis that had been done. At that point in time, you would look to enter into Safe Harbour, and that involves a formal engagement of a what people call a harbour master, a suitably qualified turnaround expert. And then we move into the planning phase, and that's developing a turnaround plan with key milestones and timing in terms of the plan. And that can be a variety of things, but that might be if you have a business unit that can be sold, or if you have a particular contractual, a particular contract that's profitable, you might be able to sell that. You might be able to sell some real estate assets, and it's can be anything as simple as that. But it can also be something more complicated, which looks at redefining key channels for a business in terms of its customers, or redefining how products are manufactured, for example. It can really be anything. There are no limits on what a turnaround plan could be. But then once that plan has been developed and put into a financial estimate, then that turnaround expert that's been appointed needs to provide the business or its directors with a written opinion on the turnaround plan, and in particular whether or not it will provide that better outcome. So it's the turnaround expert who's been appointed that will provide that view around the better outcome. And then we just move on into the implementation phase, so getting on with the plan and implementing it, talking to stakeholders, the board monitoring that plan, and keeping creditors, employees, and whatnot alert. There's no rules about the plan having to be stuck to forever. Clearly, if the plan isn't working, it needs refinement or improvement, then the plan can be and should be updated as required. And then at the very end, when the suspicion of insolvency has gone away, and creditors have been repaid or cash flow has been normalised, then that's the time when the Safe Harbour is assessed, and you can leave the Safe Harbour process. Over the page, thanks, Maddie. Just go back to Will. Now, Will, you wanted to talk about building your own forecast, and then no doubt there'll be lots of questions.
Yeah, I did. Yeah, thanks for that, Andrew. So just wanted to sort of make mention again of these online courses that we're holding. So we're running a particularly these in the first phase of these that we're running later this month. So these are half-day virtual workshops for business owners and managers, directors and things who are looking to sort of take some of the things we've discussed here to the next level. So what these workshops will do is that they'll provide you with the data you need to determine whether or not you've got a looming cash flow crisis. And these will include in them a cash flow forecast that is extremely easy to use and very easy to implement. And included in that will be the opportunity to show and to learn methods for how you might stretch your cash flow further, calculate how much capital you might need to inject into a business, and basically to sort of, if you don't have anything in place at this stage, to sort of allow you to put into place that sort of 90-day cash flow forecast, which we think is a really crucial tool. It will be supported by some BDO advisors who are sort of going to be able to assist you in answering questions and things around how you do these things and how you build them. But yeah, did want to mention that. I think fantastic program, and you will in the follow-up email receive these links and things. So if you're interested in doing it, honestly, fantastic value as well at the price for what you're going to get out of that. So did want to just mention that. And then I think we might then see if anyone's got any questions.
I've got a list of 3 questions here, but there was also that JobKeeper question for you.
Yeah, happy to do that. In fact, I've got a question for you as well, Andrew.
Oh, so, yeah, okay, sure.
So I'll do this JobKeeper question. No, I hope not. I can see the question here. So we were told that the question is, we were told the first phase of JobKeeper needs to be assessed and paid out before COB 27th of September. How is this possible when this is the last day of JobKeeper? Is there a few day leeway to assess the payroll properly? Have I been given the wrong advice? So I have to admit, I don't 110% understand the question here. They could potentially be referring to 2 things. If this question is in reference to the first phase of JobKeeper 1.0, then it's been a feature of JobKeeper all the way through, is that the employer does need to pay at least the $1,500 per fortnight in advance to the employee before they claim it back from the government. That has to be done during the JobKeeper fortnight for which you're claiming, and then you claim the money back after the end of the month. You have 14 days after the end of the month to claim it, and that has been certainly a feature of the program all the way through. If we're talking about JobKeeper 2.0, this might be making reference to what will be a very common problem, which is that the assessment for JobKeeper 2.0 will be based on actual GST turnover, and for many, in fact, the majority of businesses, in fact, all businesses, you're not required to lodge your BAS until some period after the end of the quarter or after the end of the month, and so many businesses obviously won't know. They won't be able to make the assessment as to whether or not they're eligible to stay in the program until possibly some period after the end of the month. And so then the question arises, if you have to pay your employees at least $1,500 per fortnight to claim the program, but you don't know whether or not you're eligible until you do your BAS, there's clearly a timing difference there. Look, the Commissioner has, or the Treasury has sort of confirmed that the Commissioner of Taxation has the ability to make rules to allow for an extension of time to make the payments. So, and that's been a feature all the way through as well. So it may be that when we see the final rules, there will be a period or an extension of period to allow you to meet those terms. But it is a very common problem all the way through JobKeeper. One of the other things I just wanted to very quickly mention about JobKeeper 2.0 is that it appears as though you will be able to enter JobKeeper 2.0 later, even if you weren't in the first phase of JobKeeper. Although a lot of the documentation talks about an extension of time and reassessing, so all indications that it's extending the existing program, so you had to be in it. There does also seem to be some documentation there which says, look, you can enter later if need be. So even if you qualify for the program in the quarter ending December, you will get it for March, the quarter ending March 2021. So yeah, worth keeping an eye on that as well. So hopefully that'll answer the question. If not, our contact details are on the screen there, so feel free to send us an email.
What's this
so
question
I
you've
did
got
want
for me?
look, I just wanted to ask, so just as a rule of thumb for a business owner or manager, what is the rule of thumb for when they should start seriously considering having a conversation with someone like you?
What I would say is that, there are some clients that come to me 12 or 18 months out and say, I think there's going to be a problem in 12 or 18 months time. And those clients, it's an hour coffee and they sleep better that night knowing that they've got, 12 months to think about how to solve this problem. And having had a discussion with me, they know about their duties and their responsibilities and the stakeholders they need to talk to during that time. The directors or businesses that come and talk to me today and say, I don't think I can pay payroll next week, there's not a lot I can do to help other than to help them plan for an insolvency process. So all I would say is that, once there's just the slightest suspicion that something might go wrong, then the more time we have to think about it and to develop a plan, the better. And there might not be much to it 12 or 18 months out, but we can identify perhaps some milestones or some red flags along the way that if they happen, then come back and have a proper chat. So it's all about time frame, and it's also about helping business owners and directors sleep well at night. The longer the better, and it doesn't have to be all involved 12 months out. It might just be a half hour, an hour coffee.
Yeah, I think that's good advice, and I would, even for people who without any offence, it might be a little bit intimidating to take the step of going and talking to an insolvency practitioner. I think there might be some people who might be a little bit scared of doing that. I would encourage them to just talk to their accountant, their advisor. I think there's sort of this idea out there that if you go and talk to your accountant, we have a clock on our desk and we hit the clock and we'll start charging you from the beginning, and that's certainly not the case. I think all accountants, all advisors are always happy to have a conversation and to talk to you about to talk to clients about potential issues and potential problems. And then, as I said, always happy to sort of facilitate a conversation with someone like Andrew. But I think it's great advice. You want to have that conversation as early as possible, and it really sort of ties into the advice around making sure that you're planning and having your cash flow and modeling and things in place so that you're in a position to do that. Yeah, no problem. So do you want to ask some of the others?
There was a question there. What cautions can be taken by retiring directors to absolve themselves of future liabilities or risks, or even on future business sales? And that's a pretty crazy idea that somehow things that happen into the future could come back to bite past directors. Things around directors' duties and insolvent trading responsibilities, all of those things are about what you do at the time you are a director. And to the extent that there's been misbehaviour or fraud or breaches or whatever it might have been in the past at the time you were a director, then those responsibilities never go away. But once you've retired off as a director, how can you be held responsible for the actions of the remaining directors? It's just not something that happens. If you're abundantly cautious, you might have some D&O cover at the time that you retire. I've not seen that before. I'm just sort of putting that out there as an idea. Yeah. And there was one more question. I've answered a couple of the others we've gone. There's another question. A small sole director companies with relatively small debt to the ATO and trade creditors of maybe $100,000. And the company's revenue now is nothing more than a basic wage. The director feels he can't pay this back. What options do they have? I mean, again, I think what I would do here is you would sit down and think about, what profit can the business spit out, allowing the director to continue to take a basic wage. And when you look at what cash spits out the bottom over the next, say, 12 or 18 months, is that enough to pay off your ATO and the trade creditors? And to talk to those two parties about longer term payment plans. If that's not attractive and not an option, then clearly I would say that the business is insolvent, and the directors should then take steps to put the company into some form of administration or liquidation. I think if there's some good intellectual property or some good customers or something that it's appropriate to be saved, then an administration might be a better road to take. But if we feel that there isn't enough money being generated to pay off those creditors in the medium term, and there's not much to be saved, then it would seem appropriate to me that it should be liquidated.
I have another question here as well. I might just answer. Is actual GST turnover based on how the BAS is lodged? So if you use the cash basis, you make the determination using the cash basis. So obviously this is a question again about JobKeeper 2.0 and the change from projected GST turnover to actual GST turnover. This is a really good question. Unfortunately, we don't 100% know at this stage because we haven't seen the rules, which is a real pity. I know I said to Andrew before this session, I said it's hard having to answer questions at this stage because we just haven't seen the detail. So in the first phase of JobKeeper, there was a good deal of flexibility around how you would calculate your GST turnover, and there was a ruling issued on that. And we certainly, for some clients, we went through the process of calculating their GST turnover under a number of methods, and were able to find a way in for them there. But obviously the case for JobKeeper 2.0 is it's based on actual GST turnover, and the indications there is that was effectively meant to say that, look, what goes in your BAS is the number, and it was meant to make it much easier for people. But we don't 100% know exactly how that will look, and that does sort of throw up all sorts of issues, one of them being around cash versus accruals, particularly for businesses which may have changed their methodology during the last 12 months. I know I have at least one client who did that as they grew. Also, the amounts you record on your BAS can include capital payments, so amounts you may have received for divesting yourself of capital assets, which again may not be a reflection of your actual sort of trading turnover. So it's a great question. I can assure you that once the rules are out, then we will be communicating with all of our clients and sending those out. But look, at this point, we just don't 100% know. So hopefully we will see the rules sooner rather than later. The only indication we have from the ATO at this point is that we will see them before the 24th of September, which is not fantastically helpful, to be honest, given that would give us the weekend to to get up to speed on it before it all kicked off. So look, we'll see the rules in the next couple of weeks. Inevitably, they include provisions for issues around timing and confusion, extensions of time. The commissioner has broad rules to extend time. So typically we're okay to get access to sort of concessions and things where required. So yeah, great question. Sorry I can't answer it. Look, I'm just aware of the time. It's 11:58. I think we're due to finish up at midday. So we might leave it there. I would encourage anyone who has any other questions to sort of to send them to myself or Andrew. We're always happy to have a chat. I think I would hope anyway, I think that the main point that's sort of come out of this is that how crucial it is for businesses to be planning, making sure that you're doing your cash flow, doing your three-way modeling, take advice. Now is not the time to stop talking to your accountants, your advisors and things. I think maybe that's probably the main message to come out of this. But look, thanks to everyone who came and attended the session. Obviously you'll get a recording of it later. Thank you also to the two people who sent me a text message saying they like my beard. I'll be passing that on to my wife. I appreciate that. But look, before we close, we have a short feedback survey that'll launch once we close the webinar. We really appreciate it if you could fill that out. It really helps us to sort of design future sessions. We often it can be difficult to work out exactly what people want to hear about, but we're 100% open to having sessions to talk about essentially anything that will help our clients or any business really. So thank you everyone for joining us, and we look forward to continuing discussions in the future.
Thanks, Will. Thanks, everybody.